My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. Other people make friends. I'm just trying to make you a little money. My job is not just to entertain, but to teach you. So call me at 1-800-743-CBC. Tweet me, Jim Cramer. Every morning, I write up a list of the stories I'm looking at in preparation for Squawk on the Street, the show I do at 9 a.m. with Carl Quintanilla and David Faber. You may get a truncated version in your email box every day. It's typically around 15 items, and many of them are what I call the usuals. The creme de la Cramers, the a la Magnificent Sevens, whatever you want to call them. They're often upgrades or price target increases for Tesla or Meta or Apple or Amazon, and definitely Microsoft. I bring this up after a not-so-hot day where the Dow inched up 10 points. S&P declined 0.34%. NASDAQ shed another 0.56%. Because since the new year began, I've had this explosion of positive ideas from every nook and cranny of the market, no longer just the Saint and Seven. Today's typical 45 new ideas, almost all positive except a negative note on Yeti, which was slammed by an analyst due to the popularity of this new Stanley Thermos competition. Meanwhile, we're seeing a host of invective toward the creme de la Cramers, including once again Apple, with still one more downgrade this morning. I wonder who's going to downgrade it next. It's becoming a common refrain of incredibly pessimistic proportions. An echo chamber of negativity, no doubt written on a Mac, told with an iPhone, read on an iPad, or listened to with second-generation AirPods. And you know what? It's fantastic for the stock market. That's right. You see, we need to have many new, fresh ideas, not just have a market controlled by an elite group of companies. That has no sustainability at this point. No longer do I have to come out here and just talk about 7 stocks plus or minus Salesforce and Cirrus now. We no longer have 2 markets, the supergiant tech companies and the Lilliputians. I don't think we're going to have a total convergence. The Magnificent Seven are just too big and the rest of the market is too small. But I am saying that the Mag 7 may run in place or even work their way lower, while the rest of the market might even get stronger and certainly more rewarding on a percentage basis. I always tell people, remember that. In the end, we're trying to make our money work for us, work hard for us. To do that, you need to buy stocks that go up a great deal, not just incrementally. And the Magnificent Seven now feels very incremental, mixed up with some rather upsetting slides down. There are simply better opportunities right now out there for 2024. Let me go over what I mean. Today, a legion of research firms praised the incredibly inexpensive regional bank stocks like Comerica, Truist, Huntington Bank shares. I mean, these stocks were on the ropes 10 months ago. But reports of their demise were highly exaggerated, and now they're among the cheapest stocks in the market. Hey, there was 2 upgrades of American Express today. 2 firms named the stock their top pick. While this stock has already rebounded a great deal off its lows, I think it could rally another 30 points from here at 187 before it gets too expensive to talk about. Oh, let me just throw in First Horizon. Regional Bank, $14 stock, got a $25 takeover bid not that long ago. It's just that the deal fell apart due to regulatory interference. Not related at all to the acquirer, to the actual First Horizon, but all to the acquirer. FHN, check it out. Or how about this classic recommendation we got this morning of Home Depot by Wells Fargo? Get this. This is a company we all know, right? The despot, 2.47% dividend yield, one that everybody was worried about when interest rates were soaring. But now the rates are going down. It just makes so much more sense to buy Home Depot. As the report put it, I'm going to do it a little kind of like the kind of argot that they use on the street. The 24 bar is lower. Volumes are normalizing. Long-term structural tailwinds are positive. Home aging shortages, etc. In other words, buy. Barclays jumped on the pro Home Depot bandwagon, too, upgrading the stock. They're betting that after a turbulent period, we're going to start seeing more normal levels of demand. I agree. Hey, let me throw in another Barclays upgrade. They got behind one of the worst performers of 2023, Dollar General. Last year was rare to see anything good about. They could not defend this. Dollar General was too awful. And even if they did, it would fall on deaf ears. Today, that recommendation propelled the stock up $3.50 off a $131 basis. You just aren't getting that kind of percentage gain from the Magnificent Seven anymore, at least for now. I love this morning's recommendation of Merck from Cowen. Talking about how this stock sells at 14 times earnings. Average pharma name sells for 16 times earnings. Under the hard-charging CEO Rob Davis, the current Merck is anything but below average. He's taking the money that his company makes from one of the greatest oncological franchises in the world, Keytruda, and putting it to work building out the new drug pipeline. I thought that Merck's acquisition of Prometheus Biosciences for just over $10 billion last year was a work of genius, because Prometheus has a fantastic drug for irritable bowel disease, could be gigantic, and is not in the numbers. Hey, here's one from out of left field. An upgrade to the Prosaic Allstate by Morgan Stanley. They like the insurance company because of higher rates that jumped the stock from 145 to 148.50. Hey, last year this stock wouldn't even react to an upgrade, and buyers would remain scarce. Now it probably has a multi-day move. In this market, you know what people want? They want cheap. They want value. They want the stock of an auto company that sells at less than 5 times earnings. They want GM. And that's what Wolf Research gave you today with a warm-up to the great auto company, where they stopped it with a $42 price target. Stock's at 35 and change. Hey, ask yourself, do you think you're going to get that kind of percentage gain from a mega-cap tech name? Maybe, but I think it's unlikely given how much they ran last year. Well, if they go lower, then they might be able to get it. That might have to happen. Finally, get this. A couple firms pushed Verizon. When was that? Honestly, can you ever remember a time that somebody did that? Not too long ago, the stock was a first-rate pariah. But now Wolf Research says the spending on 5G is finally waning. The telco balance sheets are starting to improve, and they see Verizon as, and I quote, a glass half full that's gaining water. Hey, you know what? That makes that 6.75% yield seem, mouthwatering. Now, I am not saying happy days are here again. Remember my position. There are too many investors who are offsides, betting we'll get a slew of rate cuts this year, when I simply don't see a reason for more than 3. The economy's too strong to justify more than that. And there are plenty of people who still think the market is just the Magnificent Seven and friends. Each day, 1 or 2 of them will pop. But you need to be wary of these upward moves, like the early morning jump in Microsoft that couldn't be sustained even after it talked about adding a button for its artificial intelligence platform, Copilot, to the PC. Let me give you another example. Today, we learned that Amazon captured a staggering 29% of online orders during the holiday shopping season. In the old days, that might have been worth, I don't know, what do you think, 5 to 8 points for Amazon? Well, guess what? Today, Amazon stock declined almost $4. That's what we're dealing with. I expect that this change in leadership will only get more pronounced as the month goes on, because analysts are seeing non-tech stocks react to their positive recommendations. After years where their ideas were almost irrelevant, as the Magnificent Seven dominated no matter what, they've now rediscovered their own relevance. But the bottom line, to me as a stock picker, I think this moment's kind of oddly joyous. We don't want 2 markets, people. We want 1 market. Well, I'd love it to be the Mag 7 and friends, and they can simply go up, say, more slowly than the other 493 stocks, the S&P 500. There's just not enough money to go around. So we've got a massive rotation going, one that isn't finished, one that could be with us for quite a long time, until the people who own the Magnificent Seven but don't know what half of them do get blown out, and it'll happen at lower prices. How about Bill in Massachusetts? Bill.
Booyah, Mr. Cramer. Booyah.
Booyah, Bill. What's happening?
I had a question for you about Danaher. I got some at 190. It's going great, and I wanted to know your opinion.
Okay, first of all, congratulations. I got some much higher, and then I bought some lower, but you did a lot better than I did for the Travel Trust. But I will tell you this. When I listen to what a Bristol-Myers is doing or a Merck's doing, they're buying these biotech companies. They're going to have to buy a ton of equipment from Danaher. That's why the stock's been red hot. That's why I think the stock is back after being away for a long time. That's why I think Danaher should be bought. How about Ryan in Connecticut? Ryan.
Hey, Jim, thanks for taking my call. I'd like to give a special shout-out to my wife, Amanda.
I'm liking that. I'm liking that kind of what, hey, I'm giving a shout-out to Lisa, my wife. She doesn't even know I have a show. What's going
on? So the stock I'm looking at has the CFO buying shares currently. The PE sitting at 14, which is significantly less than the 15-year average, 10-year average, and slightly less than the 3-year average. Is this undervalued, or am I missing something? And should I be a buyer, or should I be more patient in regards to FedEx? And when's the next book coming out, Jimmy?
Oh, well, actually, that's a secret. I happen to think that FedEx, I love the CEO of FedEx, and the fact that the stock really didn't get hit if they missed the quarter, what does that tell you? It tells me that Raj Subramanian is the Superman who is going to get FedEx to be on track. I wish we owned it for the Travel Trust. 13 times earnings, you got a winner. Philip in Michigan. Philip.
Hey, good evening, Jim.
Hey, Philip, how are you doing?
I'm doing great. Booyah.
Booyah to you.
I just wanted to give a shout-out to your staff, particularly Zev. I really appreciate the work that he does.
Totally unbelievable. Make me look great. I am really a marionette when it comes to the staff.
The economy is potentially looking like it's going to go back up. with the Fed's potentially raising rates here in the lowering rates in the near future.
Okay.
So I was looking to make my portfolio was more industrial, and so I was looking at Dow Chemical. I know you love Jim Fittering, so I was just wondering your thoughts on that.
Okay. I saw RPM be down today. It's a chemical company that I like very much, and it got me thinking, all right, don't be too aggressive with the chemicals, but that is a higher multiple has a higher price earning multiple than Dow. I like your call on Dow. It yields 5. I think that Jim is going to do a great job this year. By the way, for those who are technically inclined, it's one of the greatest reverse head and shoulders I have seen in ages. Emily in Arkansas. Emily.
Hi, Jim. You and Jeff are great with the investing club, and your Mad Money staff is the best.
Thank you very much. We are very, very good. And I always like these comments because, these people work incredibly hard, and they make me look good every day. How can I help you, Emily?
I have held some Cisco stock, CSCO, for quite some time, and I still have a small loss. Do you see a catalyst that would move the stock higher in the near future? Or
not this quarter. Not this quarter, Emily. I'm sorry to interrupt you, but no, not this quarter. I think that you're going to have another quarter and maybe 2 quarters before that stock can really make a run. It does yield 3%. Chuck Robbins is terrific, but that last quarter was a letdown. What can I say? Hey, you know what? We're not done with questions. I'm going to take questions from now until the cows come home. I'm going to go to Trey in Texas. Trey.
Booyah to you and Happy New Year, Jim.
Hey, Mooyah. That was something my daughter sent me today. She saw a sign in print that said Mooyah. I may have to just change that on a Thursday, special Mooyah day. What's going on?
Hey, so I enjoyed a James Bond marathon over the holidays, and it got me thinking about these 2 questions. First, has anyone ever told you you look like a young Pierce Brosnan? And second, is Paramount to buy on potential M&A opportunities with other streaming?
What was that first question again? I want to hear that really slow time. Paramount, I don't like the debt load. Pierce Brosnan, of course. I mean, that's like the coolest guy on earth. Can I have more questions? Because there might be a question about the late Sean Connery, who I really love. Okay, that is it. That's the end. All right. People are warming up to the rest of the market outside of the Magnificent Seven. And as a stock picker who reminds people of Pierce Brosnan, I find this moment oddly joyous because we don't want 2 markets. We only want 1. Well, man, tonight we've covered the best of the S&P and Dow. Who reigns supreme in the NASDAQ 2023? I'm revealing the top performers. Man, it's just as important to analyze the losers, isn't it? So I'm revealing the names of who landed at the bottom of the barrel. Yeah, the NASDAQ Nats in 2023, so we can figure out what could happen in 2024. And just ahead of one of the biggest and best healthcare conferences in the country, I'm getting a preview right before our trip to the conference with JP Morgan healthcare analyst Lisa Gill. So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.